Good evening. My name is Richard Kapsch. I'm the Managing Director of Pride Holdings, LLC, located in Schaumburg, Illinois. And I'm speaking to you today from Schaumburg. Before I start, I'd like to, maybe go over some of my experiences in the market to give you an idea where I've been. I've got 45 years experience in the futures markets, foreign exchange, and stocks. I've held just about every possible job that you can imagine in the industry, from a back office clerk up to president of my own investment firm. Included in that 45 years is 11 years spent on the floor of the Chicago Mercantile Exchange. And out of that 11 years, I was also on the Board of Governors at the Merc for 6 years. While I was on the Board of Governors, I was chairman of the Foreign Currency Committee. I've got a Bachelor of Arts degree from Yale University and an MBA in Corporate Finance from New York University. Today, what I plan to talk about is trading and management. Before I do that, though, I want to just one administrative thing. I will stop at the end of each slide and give you people an opportunity to ask questions. So finish the slide, and I'll say any questions, and if anyone's got a question, they can ask. Okay?
Okay.
All right, when you talk about trading, whether it's foreign exchange, commodities, or stocks, some people will tell you you're doing nothing but gambling. So my question to start today is trading gambling, or is it speculation? If I consider trading to be a form of speculation. Now, what is the difference between gambling and speculation? In gambling, the outcome is random. What your return or everything is strictly random. It's like flipping a coin. You either get heads or tails. Heads you win, tails you lose. And that's about all you can do in terms of the trade. It's like going to the casino and playing the slot machines. Speculation, I like to think, is a little more sophisticated than gambling. And the speculator is somebody who's willing to take on risk, and there's a substantial risk associated with trading. Somebody who's willing to take on risk in exchange for receiving returns that are commensurate with that risk. And the greater risk you take, the more return you should expect. If you're going to take on the risk of trading, you don't want to settle for small returns time after time. The other difference between gambling and speculation is, in speculation, you can improve your outlook or your outcome by learning as much as you can about what you're trading. And we'll talk about that in a second. Any questions so far?
No.
Okay, I believe there are some basic... I'm sorry, what? Somebody have a question there? Okay. I believe there are some basic keys to trading that everyone should keep in mind. First is knowledge. I think when you're trading, you should know as much as possible about what you're trading. There's an axiom in the markets that says trade what you know. For example, if you're a gold dealer or a jeweler, you're probably better off trading gold than any other type of instrument, because you've got a leg up on the other people in the market. If you deal in the oil markets, you should trade crude futures. So what you have to do is know as much as possible about what you're trading. If you're trading foreign exchange, you want to learn as much about the foreign exchange markets as you can. going over some of the things we talked about in the first 2 weeks. Okay, the second principle of trading is you have to have discipline. If you've got a trading strategy that's working for you, stick with it. Don't jump all over the place and try one strategy after another. Or if one of your friends says, hey, I think the euro's going up today, I'm not sure why, but somebody at the bank told me he thinks it's going up. You don't want to, if you've got another trading strategy, you don't want to buy or sell based on that friend's recommendation. I had a very good example of discipline shown to me one day about 30 years ago when I was working for a firm called E.F. Hutton. I was in the trading room in their foreign exchange trading desk in London, and one of their major foreign exchange traders happened to be in the room at the same time, and there was a big important U.S. economic number coming out at 1:30 in the afternoon, just as the markets were opening. This individual traded foreign exchange futures, and all he did was trade on market on close. He'd buy or sell the market at the close of trading rather than the opening. Well, he was long a particular position in the foreign exchange, and the number came out that was disastrous for his position, and his position immediately started to go against him. And the head of the foreign exchange desk said to him, do you want me to get you out of your position right now? And the guy said, no, my system says market on close. If we'll wait until the close, if the position's against me and my system tells me to get out, then I'll get out at that time. So that was an example of discipline. And he was an extremely successful trader, and you get one little setback shouldn't set your line. So the important thing to remember about discipline is if you have a strategy, stay with it. If it's working, don't deviate from that strategy. Don't jump all over the place and try one thing after another that may be new. The third principle that I think is important in trading is humility. Just because you got to remember that nobody is bigger than the market. Just because you may have 3 or 4 or 5 winning trades in a row, you're an expert. You got to remember that the market can always jump up by doing the rear end. So you got to remember that the market is bigger than any individual trader, and you got to respect the market accordingly. Okay. Now, what about trading stocks versus derivatives? Some people like to trade stocks and derivatives. In my opinion, I think the stock market is at least 70% based on the moves in the stock market are 70% based on psychology of traders. How do they feel about the market? How do they feel about the president and things like this that might affect the market? Derivatives, on the other hand, are almost 100% fundamental, based on fundamentals. So I prefer to trade something in fundamentals you can analyze and understand, psychology. Who knows what somebody may be thinking at any one time in the market. So my preference is to always trade derivatives rather than stocks. Okay, any questions so far?
No questions.
Okay, thanks. Okay, there are certain cardinal rules of trading that I think you should adhere to, any trader should adhere to. And we referred to some of these last week. So some of this may seem like kind of a review, but I think these are important things you to hammer into your trading strategies. And the first is that successful traders lose on 70% of their trades. So if they're successful, how could they lose on 70% of their trades? As we said last week, the reason they're successful is because the 30% trades that they win on are much greater than the losses they suffer on the 70% they lose. If you're familiar with U.S. or American baseball, a 300 batting average or 30% winners get somebody into the Hall of Fame. So just remember that. Just remember that successful traders lose on 70% of their trades. So how do they guarantee or 70% of their losing trades? And the first principle they follow is to cut your losses short and let your profit run. So if you've got a trade that goes against you and isn't doing what you expect it to do, don't stick around waiting for it to get out of that trade and for the next winning trade. It's run. We talked about how last week we said that I think that currencies are the best trending markets. The thing to do is identify trends and try to ride the trend as long as you can. Now, how can you do that? We said fundamental analysis is good for telling you where a currency should be or where a market should be at some point in the future. And that's what establishes the underlying trend, but it doesn't tell you where to get in and out of that trend. For that, the best tool that I think you can use to identify trends is technical analysis. A picture is worth 1,000 words. So you can look at a chart and you can pretty much pick out which markets are trending. If it's a choppy market that's moving from just side to side, obviously there aren't going to be too many trading opportunities on that. On the other hand, and this is what you can see in just about any currency, when a currency starts to trend, that's one of the points where you can jump in and try and ride that trend as long as you can. Kind of like these surfers do off the beaches of Hawaii. They wait for the big wave rather than every small little roller. So what you want to do is follow the trend, and remember that the trend is your friend. Don't buck the trend. Don't buck the trend means don't go against the trend. If the market is moving up, don't try and pick a top to the market. Just stay with it. If the market's going down, don't try and pick a bottom, and just stay with it on the downside. Now, how do you do that? I suggest using trailing stops. When you enter into a market or your first trade, put a stop below the market. If it's a buy, put a stop below the market. If you get stopped out, will give you an acceptable loss. Okay, but on the other hand, if the market starts to move in your favor, move that stop up. So maybe move the stop up to where you got into the trade in the first place. So if the market turns around, you get stopped out and you don't lose. If the trend continues to go in your favor, keep moving that stop higher and higher as the trend goes. But don't try and, as I said, don't try and pick a top to that trend. If the trend runs out, it's ultimately going to turn around and it'll trigger one of your stops and you'll wind up with a nice profit in the market. Okay, the third rule is use money management. By using money management, I mean conserve your capital. Don't put all of your capital into one trade. Maybe put 25 or 30% into a trade. So if that trade is a loser, you get stopped out, you still got 70 to 75% of your capital left for another trade. So in reviewing the three basic rules of trading, one is successful traders lose on 70% of their trades, but they win on 30%. They do that by cutting their losses short and letting their profits run. And finally, use money management so you don't commit all risk in the hope of achieving a return that's commensurate with that risk. Now, what does that mean? That means the greater the risk you're willing to take on, the greater return you should be expecting. And we'll talk a little bit about risk and return, but let's talk about return on investment. Okay, let's take, in this example, we've got two investments.
Okay, grande.
We've got investment A, which requires an initial payment of $10 million and gives you a projected profit of $1 million at the end of your investment period. Investment B requires an initial payment of only $200,000, but you only wind up making $100,000 at the end of your investment period. Now, which is the best investment, A or B? And I'll try and answer that question, okay? Do is calculate your return on investment. You've got two completely different investments, one $10 million and one $200,000.
Yeah.
So to calculate return on investment, we plug into the following formula. Return on investment equals the profit or net gain from investment divided by the amount invested times 100%. Okay, I'm having trouble talking over somebody there. Okay, so we plug into for investment A, the return on investment will be 1 million divided by 10 million, or 1/10 times 100% gives you a 10% return on investment. For investment B, we've got a 100,000 return profit divided by $200,000 amount invested, or 0.5 times 100% gives you a 50%. So investment A, which winds up giving you a higher absolute value in terms of total profits, is a return of only 10%. And investment B, which has a smaller investment and a smaller profit, winds up with a return on investment of 50%. So all other things being equal so far, investment B looks like the best investment because the return is 5 times higher in investment B than it is for investment A. Everybody follow me so far?
Absolutely.
Okay, the one problem with that, looking at strictly at return on investment, is it doesn't take into account the risk associated with each investment. Okay, so let's take a look at two more investments. Investment C, it gives us a return on investment of 10%, and investment D, that gives us a return on investment of 3%. Now, what we want to do is calculate the expected we arrived at these numbers by calculating the expected return on those investments. So let's say investment C, even though our expected return is 10%, we see that there's a 50% chance of earning 40% on our investment, but there's also a 50% chance of losing 20%. When you plug into this formula where you multiply the probability times the return, in other words, 0.5 times 40% plus 0.5 times minus 20%, you arrive at that return of 10%. Investment D, on the other hand, says that we have a 100% chance of earning 3%. So now again, we ask the question, which is a better investment? And the answer so far is we can't tell because we don't have enough information. The answer is dependent on what we call the investor or the trader's aversion to risk, or risk aversion. So let's talk about risk aversion. Any questions on anything I've said so far?
No.
Okay.
No question.
Okay. I'm trying to switch to the next slide. Okay. What we have here is a diagram of what I call the risk aversion diagram. And the horizontal axis gives us the return associated with certain investments, and the vertical axis talks about the risk associated with those investments. And down in the lower left-hand corner, we have something called RF, which is the risk-free investment. It's actually a little bit greater than zero, but it's pretty close to zero. So the risk-free investment gives you zero risk, but there's also almost no return. And in this case, if we invest in a portfolio of stocks, expect a higher return. Risk-free and the portfolio of when we invest in a portfolio of stocks rather than the risk-free investment like treasury bills, we expect a higher return, and that's shown where the yellow meets the white on the horizontal axis. That gives us the return on a portfolio of stocks. However, to achieve that return, we've got to take on more risk. And that's also presented on the vertical axis for M. So because M represents a stock portfolio, which is a riskier investment than a risk-free investment, we've got to take on more risk to achieve that return. Now, if we keep going out to where we see the CURR, that represents a trade or an investment in currencies. And you can see that we've got a higher return than the stock portfolio, where the yellow meets the blue. But to get that return, we have to take on more risk. So when we talk about risk aversion really has two meanings. One means aversion to all risk. And that means, you don't want to trade if there's any risk of losing any money. That's obviously not going to help us in trading. But risk aversion, the second meaning, means the return on that investment should be commensurate with the risk that one's willing to take on. So you can see an investment in the stock portfolio has a higher risk and a higher return than the risk-free investment, and then correspondingly the currency investment has a higher risk than the stock portfolio, but also enables you to get a higher return. And when we talk about risk aversion, every individual trader has his own degree of risk aversion. And it's only he that can understand what type of risk he's willing to take on. But if he's willing to take on that risk, he should shoot for a return that compensates him for taking on that risk. Now, if you're going into foreign exchange trading, you want to make sure that the capital that you're investing in this trade is something that you are willing to lose to possibly all that capital. We call it risk capital. You don't want to have money that you set aside for the kids' college education or for health expenses. You don't want to trade that in foreign currencies. So you've got to remember that you should be only trading with risk capital, and that what you're willing to do when you're trading foreign currencies is you want to shoot for a return that compensates you for the additional risk you're going to take on. So we've got our return on investment that we looked at, and we also have to calculate what the potential risk is of that investment, and make sure that when we make a trade or invest in a particular portfolio, that the return that we're shooting for is great enough to overcome this additional risk we're taking on. You don't want to limit yourself to the risk. You don't want to limit yourself to the risk of a stock portfolio or the return of a stock portfolio and take on the risk of a currency portfolio. Okay, does everybody understand that, or do I have any questions so far?
We are following.
No questions.
Okay.
No questions, thank you.
All right. Let's look at one other factor.
No questions.
Okay. Thank you. Let's look at one other factor now that enables you to possibly earn extraordinary returns on a currency investment, and that's the principle of leverage. What we have in this picture is the picture of a simple lever. This was a device that was discovered by the old Greek scientist Archimedes about maybe 3,000 or 4,000 years ago. And the principle of a lever is such that by exerting force where the arrow is, you can lift a heavy weight where the ball is located. The longer that triangle in the middle is called the fulcrum. So as you press down with the arrow, the ball rises. Now, by extending the lever further and further out to the right, you can lift a heavier and heavier weight. And that's the principle of leverage. Okay, now let's apply this principle to finance. In finance, leverage is defined as using other people's money to make money. So let's look at an example of how leverage works. Okay, let's say we have our investment has an initial investment of $10 million. This is an investment, going back to investment A that we talked about earlier. We have an initial investment of $10 million, and we're going to expect to have an expected profit of $1 million as we calculated return on investment earlier. That gives us an ROI, a return on investment of 10%. Now, how can we improve that return on investment? Okay, let's say we've got the same investment of $10 million, but instead of investing all our own money in $10 million, let's say we invest $1 million and borrow the other $9 million at 5% for 1 year. Let's say the investment horizon for this investment is 1 year. At the end of the year, we're going to have to pay interest of 5% of $9 million, or $450,000. Our net investment was $1 million out of pocket instead of $10 million. So we subtract that $450,000 from the $1 million that we invested up front, and it gives us a net profit of $550,000. So by calculating the return on investment on this using leverage now, we divide the $550,000 by 1 million and multiply by 100%. And that gives us a return on investment of 55%. So what we've done by by using somebody else's money, in other words, borrowing at 5%, we were able to increase our return on investment from 10% to 55%. Now, when you're trading foreign currencies, this is a ratio of 9 to 1. You know, you borrow 9 million for 1 million. Foreign currencies, it's more like 20 or even more greater to 1. So you're putting up $1 and you're essentially borrowing the equivalent of $20 when you're trading on foreign exchange. And it's this leverage that enables you to generate these much higher returns than your basic simple investment that generated only a 10% return. Everybody understand how leverage works on the upside so far? Okay, I'll take that as I assume everybody's...
Yes, we understand.
I'd either understand or you're asleep. Okay?
We understand, Richard.
Okay. So I'll take at least one person's awake there.
More than one, Richard.
Okay. Now, the problem with it is leverage has a downside. Now, let's go back to example A, where we had, instead of a profit of $1 million, we had a loss of $550,000 on that investment. Because we invested $10 million and lost $550,000, our return on investment, 550 divided by 10 million times 100%, gives us a loss of 5.5% on our investment. Now, using leverage, our net loss is equal to the actual loss plus the interest that we have to pay to repay that loan. So our net loss is 550,000 minus 550,000 minus 450,000 gives us a loss of $1 million. Now, when we calculate the return on investment on the downside, we've got minus 1 million divided by 1 million is minus 1 times 100% means we've lost 100%. Well, we've wiped out our entire investment in this case. So what we show in this particular example, the use of leverage increased profit, the positive expected return by a factor of 5.5%, but it caused the negative expected return to increase 20 times. So you always got to remember in trading these markets, whether it's currencies or anything else, you're losing extreme leverage, and it can work for you on the upside, but you've got to remember that on the downside, you lose it much faster than you made it on the upside. So you have to always keep this in mind. So in summary to what I covered today, I think you should always understand the relation between return and risk when you're making any investment, whether it's currencies. You don't want to just say, hey, I think the euro's going to go up 2 cents today, and therefore I'm going to buy it and make a nice profit. You've got to remember what the risk associated with that investment is. And always keep that relationship in mind when you're trading. Always remember that the return that you get on your investment should be enough to compensate you for the risk you're taking on. We talked last week, somebody was saying how when he makes a trade, how it seems like he takes his profits and he always gets stopped out. His losses 3 times as much as he made on the upside. And then in this case, what you've got to do is you've got to change your trading so that if you're going to put a stop loss in and be willing to incur the loss of that stop, when that stop gets triggered, you got to make sure that the winning part, your profit objective on the trade, is much higher than it has been. Okay? So that's basically all I want to cover today. Does anybody have any questions, anything we covered? No questions.
No questions.
Okay, well, thank you. Next week we've got another presentation on next Thursday. We're going to have another webinar at the same time, and we'll talk about futures and trading in futures. So I hope to see you again next week. So thank you.
Thanks a lot, Richard.
Thank you so much.
Okay, you're welcome. I'll see you next week.
See you next week, Richard.
Okay, can't wait.